There is a type of person you probably know. You might work with her. She drives a car that is 4 years old. Nothing wrong with it. Just not new. She brings lunch most days. She doesn't talk about money. She doesn't post about vacations. She doesn't wear anything that makes you look twice. Her name is Polly. And in 11 years, Polly went from 0 to $1.1 million. Without a second job. Without crypto. Without inheriting a single dollar from anyone. Nobody noticed. That's the point. What Polly figured out is that wealth is not built through dramatic moves. It's built through boring ones. The kind that feel like nothing. The kind you do on a Tuesday evening without telling anyone. The kind that make your friends think you're being too careful, while they're actually the ones falling behind. This video is about 12 of those habits. Not 12 things you've never heard of. You've heard of most of them. The question is whether you're actually doing them, consistently, without stopping, without needing it to feel exciting. Because Polly wasn't excited. She was just steady. And steady is what $1.1 million looks like up close. Habit 1. Polly automated everything before she felt ready. In 2014, Polly was earning $52,000 a year. After rent, groceries, and her car payment, she had about $380 left each month. That felt like nothing. She didn't feel ready to invest. She didn't feel like she had enough to make it matter. So she set up an automatic transfer of $200 every payday. $100 went to her Roth IRA. $100 went to her brokerage account. She didn't touch it. She didn't watch it. She just left it running. Over the next 10 years, that $200 every 2 weeks grew to $84,000 in total contributions. With market returns averaging 10.5%, that account is now worth $143,000 from $200, from not feeling ready. Most people wait until they feel comfortable enough to invest. Polly figured out that the comfort never comes on its own. You have to build it by doing the thing anyway. Automating first, before lifestyle expands, is the move that almost nobody makes when they're starting out. Polly made it at 27, sitting at her kitchen table on a Thursday night. She never had to think about it again. Habit 2. She kept one credit card and paid it in full. Every month, without exception. Polly's credit score today is 811. That number matters in ways most people never calculate. Her mortgage rate is 6.51%. Her neighbor, same income, same neighborhood, same purchase price, got 7.18%. The difference in monthly payment is $183. Over 30 years, that is $65,880 in extra interest paid for the exact same house. The only difference was the credit score. Polly has never paid $1 of credit card interest. She uses the card for everything: gas, groceries, subscriptions, car repairs. But she pays it in full on the first of every month. The card earns her 2% cash back on everything. Last year, that returned $847 to her account. She didn't earn extra money. She just stopped giving it away. Habit 3. She never upgraded her lifestyle when her income went up. This one is the hardest because it goes against everything around you. When Polly got promoted in 2017 and her salary went from $52,000 to $67,000, her friends expected her to move. Her coworkers assumed she'd get a new car. She did neither. She kept her same apartment for 2 more years. She kept driving the same Honda. And she redirected the entire $15,000 income increase, about $9,800 net, straight into her investment accounts. That one decision, made in 2017, is now worth approximately $31,000 in her portfolio due to compounding. A nicer apartment would have cost her exactly that. Plus furniture. Plus moving costs. Lifestyle creep is not dramatic. It doesn't arrive as one big purchase. It shows up as a slightly nicer apartment, a slightly newer car, a slightly more expensive gym membership. Each one feels reasonable. Together, they consume every raise you ever get and leave you exactly where you started, just with better stuff and the same bank balance. Can you guess what happens next? Because the next habit is the one that surprises people most. And it involves a spreadsheet she's kept for 11 years. Habit 4. She tracked her net worth once a month. Just once. Not obsessively. not daily. Not with an anxiety spiral every time the market dipped. Once a month, on the last Sunday, Polly opens a spreadsheet she's kept since 2013. She enters 4 numbers: checking balance, savings balance, investment balance, and outstanding debt. She subtracts the debt from the assets. That's her net worth. She writes it down. She closes the spreadsheet. In January of 2013, that number was negative $14,200. By January of 2017, it was $32,400. By January of 2021, it was $287,000. Today, it is $1,147,000. She didn't time the market. She didn't pick winning stocks. She just watched the number go up, slowly, with a few dips she ignored, and kept going. Tracking created accountability without anxiety. A dip in March was just a dip in March. She had data going back 11 years. She knew what dips looked like. She stayed. Most people who panic sell do so because they have no context. Polly had context. Habit 5. She bought used and drove it until the wheels came off. Polly has owned 2 cars in her adult life. She bought her first one, a 2011 Honda Civic, used in 2013 for $11,400. She drove it for 9 years. When the transmission failed in 2022, she bought a 2019 Toyota Camry, used for $19,700. Her monthly car payment is $0 because she paid cash. The average new car payment in America right now is $740 a month. Over 9 years, that is nearly $80,000. Polly spent $11,400. The difference went into her investment account. At 10.5% annual return, that difference is worth $112,000 today. She bought a used car and turned it into $112,000. Nobody congratulated her. Nobody told her she was making a smart move. Her coworkers drove newer cars and paid $740 a month and thought nothing of it. That is the thing about boring habits. They don't announce themselves. You only see them in the numbers, 10 years later, when the gap becomes impossible to ignore. Habit 6. She learned one financial concept every month. Not a course, not a certification. One concept. 30 days of slow absorption. In January of 2015, it was compound interest. How it works, what the actual math looks like over 30 years. In February, it was tax-advantaged accounts. In March, it was expense ratios. By the end of 2015, Polly had learned 12 financial concepts. Not perfectly, not in technical depth, but well enough to make better decisions than she made the year before. She didn't feel educated. She just felt slightly less confused each month. And slightly less confused, compounded over years, becomes something that looks a lot like expertise. Most people try to learn everything at once and burn out, or they learn nothing and stay confused forever. The monthly one concept rule is boring enough to actually sustain. Habit 7. She has an emergency fund she has never once been tempted to spend. Polly keeps $14,800 in a high-yield savings account earning 4.6%. That is $680 per year in interest just sitting there. But the emergency fund isn't there for the interest. It's there because every time something unexpected happened, she paid it with cash. The car repair in 2018, the medical bill in 2020, the furnace replacement in 2023, $3,400. She paid them all from the emergency fund and never touched her investments. Most people don't have this. When something breaks, they put it on a credit card at 22% interest, or they pull from investments, triggering taxes and penalties. Each of those options costs more than the emergency itself. The emergency fund doesn't feel exciting to build, but the day you need it, it is the most valuable thing you own. Habit 8. She said no to things without explaining herself. This one sounds like it's about personality. It is actually about money. Polly was invited to a destination bachelorette party in 2019. 3 nights in Nashville, shared Airbnb, dinners, activities. Total cost estimated at $1,400. She said no. She didn't explain. She didn't apologize beyond a simple decline. She sent a gift and moved on. She was invited to go in on a group beach house in 2021, $800 per person. She said no again. The social pressure to spend on experiences with other people is one of the most underestimated forces in personal finance. It doesn't show up in any budget category. It looks like friendship, like fun, like being a good person. But over 10 years, those social spending decisions can easily total $15,000 to $25,000. Polly kept hers close to zero. Not because she never went anywhere, because she chose deliberately and said no without drama when something didn't fit. Most people can't do that. Polly practiced until she could. The next habit is the one most workers are literally leaving money on the table to avoid. It takes about 6 minutes to set up and never needs to be touched again. Habit 9. She maxed her employer match before anything else. Polly's employer offers a 401k match of 4% of salary. For years, she contributed exactly 4%, not $1 more, not $1 less, just enough to capture the full match. On a $67,000 salary, that's $2,680 from her, matched by $2,680 from her employer. That employer match is a 100% instant return on her money. Better than any investment, any savings account, any asset class available to her. Studies consistently show that roughly 20% of eligible workers in America leave employer match money on the table. They contribute nothing or contribute below the threshold and forfeit free money. Over a 30-year career, at $2,680 per year in match money invested at 10.5%, that unclaimed match grows to $583,000. $500,000 left sitting on the table. Polly saw the math in 2013, earning $52,000. She contributed 4% from her very first paycheck. She never thought of it as optional. She thought of it as the first obvious move. Habit 10. She ignored financial news almost entirely. This one surprises people because it sounds irresponsible. It isn't. Polly checks her investment accounts once a month. Same day she checks her net worth spreadsheet. Between check-ins, she does not watch financial news. She does not track daily market movements. She is aware, in the broadest sense, that markets go up and down. She has decided, deliberately, that none of that information changes what she does. This is not ignorance. It is discipline. Research on retail investor behavior consistently shows that the more frequently people check their investment accounts, the worse their returns. Checking creates the temptation to react. And reacting, selling in a downturn, buying after a run-up, is how ordinary investors destroy returns that passive holding would have protected. In 2020, during the COVID crash, Polly's portfolio dropped from $187,000 to $141,000 in 6 weeks. She saw it. She wrote it in her spreadsheet. Then she kept her automatic contributions running. She didn't open the account again until April. By April, it had recovered to $168,000. By January of 2021, it was $287,000, higher than it had ever been. She didn't do anything. She just didn't panic. Doing nothing was the hardest habit she had, and it was worth $146,000. Habit 11. She bought the cheapest house in the nicest neighborhood she could afford. In 2019, Polly had $71,000 saved for a down payment. The average home in her target area was $387,000. She found a house that needed cosmetic work, not structural work. Listed at $319,000. She bought it. Her neighbors had nicer kitchens. Her neighbors had updated bathrooms. Her house was the least impressive on the block. That was the point. She spent $22,000 over 3 years on renovations, done one room at a time. Today, the house is worth $431,000. Her total all-in cost was approximately $358,000. That is $73,000 in equity built on top of her down payment. And her monthly mortgage payment of $1,847 is $340 less than comparable rentals in the same neighborhood. The cheapest house in the best neighborhood you can afford is one of the oldest real estate principles in existence. It is also one of the most consistently ignored, because people want to impress with their house. And the cheapest house doesn't impress anyone. It just builds wealth quietly, while everyone else's nicer houses do the same thing at higher cost. Compare that to someone who stretched their budget for the impressive house. higher payment, higher taxes, higher insurance, less left over each month for investment, same neighborhood, different outcome. Habit 12. She never stopped, even when it felt pointless. This is the one nobody wants to hear because it doesn't feel like a habit. It feels like a personality trait, like something you either have or you don't. But Polly will tell you differently. There were years when she felt like she wasn't moving at all. 2015 was hard. She was contributing, tracking, avoiding lifestyle creep. And her net worth went from $18,000 to $24,000. $6,000 in an entire year. After all that discipline, $6,000. She almost stopped. She almost decided it wasn't working. She opened her spreadsheet and looked back at 2013, negative $14,200. She was now at positive $24,000. That was a $38,200 swing in 2 years on a $52,000 salary. She kept going. The math on persistence is this. The first $100,000 takes the longest. For Polly, it took 4.5 years. The second $100,000 took 2 years. The third took 14 months. The fourth took 10 months. By the time she had $500,000, every additional $100,000 was taking less than 8 months because the base was working for her. This is the part of wealth building that nobody talks about, honestly. The early years feel like almost nothing is happening because almost nothing is, in absolute dollar terms. But the mechanism is being built. The habits are being locked in. The account is compounding. And then one day the number moves more in 1 quarter than it used to move in 3 years. That moment doesn't come early. It comes only to the people who stayed when it felt pointless. Polly stayed. She kept contributing $200 on payday. She kept tracking the number once a month. She kept driving the same car. She kept bringing her lunch. She kept saying no to things she didn't want to fund. She kept ignoring the news. She kept learning one concept a month. She kept the emergency fund intact. She kept capturing the employer match. She kept the credit card paid in full. None of it was exciting. All of it worked. There are 12 habits in this video. Most people watching right now already know about at least 8 of them. Knowing about them and doing them, consistently, quietly, without an audience, are 2 completely different things. Polly knew about compound interest at 22. She started acting on it at 27. That 5-year gap cost her, by her own calculation, approximately $67,000 in lost growth. She doesn't dwell on it. She just mentions it when people ask her when they should start. The answer is always the same. The answer is before you're ready. The answer is before it feels like enough to matter. The answer is before you have the perfect plan. You already know the plan. You've just heard 12 parts of it. The only question now is which one you put on automatic before you go to sleep tonight, not next week, not when it feels right, not after the next raise, not after the debt is gone. Tonight. One habit, one decision. One Thursday evening at a kitchen table, just like Polly, and 11 years from now, nobody will notice. Until they do the math.